What's Making Headlines? Your weekly wrap-up of the biggest news stories in the Australian mortgage and finance broker market.
Hello and welcome back to What's Making Headlines, your weekly wrap-up of the news on The Advisor. The Advisor team here with you again in full this week. It's Ben, Will and Annie talking all things news. Happy new financial year, guys. Exciting times.
Start of a new financial year, which is, seems like it was only yesterday. It was the last financial year, which pretty much was,
It has rushed by,
It has rushed by. We're in July already. And as I say, FY25 sounds so futuristic. Everybody now thinking about what's going to be coming up for the year ahead, what's going to be happening to rates, what's going to be happening in the property market. And with the new financial year, lots of new things happening, including some of the new housing schemes that we've been talking about for the last few years from the government, including the home guarantee schemes and some other new ones coming up as well this year. Will, you've been covering this for us on The Advisor. What do we know so far about what's happening for some of the housing schemes this year?
So I'd say most of it was actually previously announced, but just going into a bit of detail for brokers, I'd say in terms of the major free ones, Help to Buy, which obviously previously announced, but that's being extended. Home guarantee schemes, as you said, also being rolled out, and so that's going to change, being rolled out, but then will change again this year. But they haven't announced a date for that. And then instant asset write-off, again, they said they'd extend it, but that's the 20k limit is also being extended for another tax year.
Yeah, so Help to Buy, I mean, this is always the way, I think, after a federal election, is that it takes ages for anything to actually get passed through Parliament. So I don't think we go back to Parliament until late July, maybe the 20th, something like that. So we're still waiting for stuff to actually go through Parliament, get passed, the legislation get passed before we get any detail. But we did see some new detail around Help to Buy just before the federal election. So they said that they were going to be increasing the income limits for it. And I think what's interesting about this scheme is the shared equity scheme, where government will take a proportion of the equity in your house so that you can have a lower deposit, is that we don't actually know when it's starting, firstly. So at some point it will happen, TBC, probably in the next few months. So we're waiting to see the detail around actually when it will open. But so far we know some of the detail. They did actually update the parameters of what the Help to Buy was going to be earlier this month. So we had a few more bits and pieces come through, for example, around the income limits. So it's 100k for single borrowers and 160 for joint borrowers. That was higher than initially announced, although, again, it hasn't started, so we don't know when that's going to be. And then talking about the kinds of eligible loans. So it must be like a single first mortgage with the lender. They have to be variable or fixed. It can't be interest only. It requires P&I repayments over a maximum of 30 years. And also applicants must obviously grant a second mortgage to the government because they're taking a stake in it. So lots of different things in there. That was quite interesting. And new placements in the guarantee schemes. How many have we got?
Yes. So that was announced this week. 50,000 new home guarantee schemes, and that's split over, so first home guarantee, 35,000, regional first home buyer, 10,000, and then 5,000 for family home guarantee.
Yeah, actually, I should say Help to Buy. We also found out this week that there's 10,000 places under that as well.
Yes, yeah. So more changes there. And then obviously the government committed in the run-up to the election to, I think, look at it or reform it. And I actually reached out to Housing Australia. They said, in terms of income and price caps, they're exactly the same for now, but they are likely to change this year, but no details or date.
Yeah, so I think Prime Minister Albanese was saying that it would be from January 2026 that these new expanded thing would come through. But as we said, still no detail on it. We still need to see the legislation go through to change it. So I think what he was saying at the time during the election campaign was that it would be pretty much open to everyone. So they'd be removing the income limits and the caps. So it could be like if you're going to be buying a property for the first time, or you're going to be using buying a regional property or, a family property, you can access these guarantees regardless of where you are, what your income is, and what the property price is as well, which I think would be pretty interesting. But devil is in the detail. Who knows if that's actually what will pass, because all things could change before January. So we've got to wait and see. But obviously, we'll keep you posted as we go. And then the other thing, that Prime Minister Anthony Albanese promised before the election and then repeated this week was the extension of the instant asset write-off. And that's something that lots of people were worried about, because if they hadn't extended it, it would go back to the default $1,000, which obviously doesn't get you a lot of asset.
Yeah, there was quite a bit of uncertainty about what was going to happen with that, particularly in the lead up to the election. I think the coalition said they were going to extend it to 50 grand or something like that.
Yeah.
The federal government hadn't really detailed its plans in full until really the last minutes.
Absolutely, because it wasn't in the budget.
Yeah. And then they had to say...
Update it.
Yeah, actually.
Oh, whoops, by the way. And same for the guarantee schemes, actually. I remember when we wrote the budget story, we were like, instant assets not in there, and the guarantee schemes aren't in it. I think there was one missing, which maybe was... test my memory here, but I think maybe first home buyer guarantee was missing from the budget papers, and then they had to kind of be like, oh yeah, and we just put this like, there was a section, I think it was basically equivalent of other in the budget, which was massive, and that was basically saying, because we don't know if we're going to be winning the election, and if we do, things might change, like instant asset, like the guarantees. So they were apparently bundled into the other category.
Yeah.
So we did find out later that they were going to be expanding. But yeah, instant asset write-off, even now, because they haven't passed the legislation, lots of people being like, well, what happens if I buy an asset now? Like, can I actually use this? How does the ATO treat it? Because we don't have the formal sort of structure in place yet. So the suggestion from Albanese is that it will be extended this year. I have no idea when that legislation will pass, and because it took so long last year. I think they actually ended up passing it in like April for FY25. So you only had like a month left or something, 2 months left. So I think, we'll see it. But he did say in Canberra on the 30th of June, and I'm quoting, from tomorrow, the extension of our instant asset write-off of $20,000 kicks in. So right across the board, we've got considerable support kicking in tomorrow to provide that ongoing cost of living relief. So he said it.
Yeah.
We just got to hold him to it. Yeah, we've reported that. And then I think other things outside of the new financial year, as is always the case, the turn of a financial year, we always see loads of things happening, both from a business perspective, but also from an appointment perspective. Big story this week, Ben, another merger in the mutual space actually completed.
Yeah, so as of the 1st of July 2025, Kudos Bank and Bank Australia have officially merged. They become sort of a new banking group with $18 billion in assets, 900 employees, 300,000 customers. It's sort of, we've known about this for a while. And when the members of both banks voted for on the merger, it received pretty strong support, I believe. I think 78.4% of Kudos Bank members voted in favour, and 91% of Bank Australia members voted in favour. This is just another merger we're starting to see in the mutual space. We've seen heaps of mergers in the past few months.
Heaps, absolutely heaps.
Years, I guess.
Yeah. And I think because a lot of them are now really aiming at, I think it was APRA that was talking about it way back when, maybe in like 2020, 2021, and saying mutuals are going to have to merge in order to compete with things like technology and the costs of actually running a banking group, and obviously with mortgages going and cybersecurity, there's just a lot more expensive to run a bank, and they were kind of saying they're going to have to merge to survive, which obviously they have been. I think now the benchmark is looking at, probably needs to be around $20 billion of assets for a big bank to kind of be like competing. So this is why we're seeing a lot of the mergers now. I think most of the mergers we've had recently, they've been forming banks that are around that sort of 17, 18, 19 billion dollar mark. So it won't take long for them to get up to 20. But yeah, lots of big changes there. And because of the merger, they also said goodbye to Brendan Wright, who many people might remember from when he was at Planchoice Fast Group. He was the CEO at Kudos, and because obviously a lot of his job was actually walking them through this merger, he's kind of now departed. So we'll have to wait and see where he turns up. I did have a chat to him this week as well, being like, where are you going, Brendan? Give us the story. And he was like, you'll wait and see, Annie, I'll be in contact. So I think hopefully he stays in the broker channel, and obviously he's done a lot for that bank. But now we've got new CEOs and management at Kudos Bank. So
Damien Walsh becomes the new CEO, and Jennifer Dalitz, who was formerly the Kudos chair, will lead the board. And one other thing we should mention is both banks will sort of continue to operate under their existing brands. So there's not going to be a new
major changes,
name and that kind of thing. which is important to keep in mind.
Yeah, so Bank Australia will still be around, Kudos Bank will still be around for the foreseeable future. And again, I think a lot of the themes we've seen from the mergers that have been taking place is that for at least a year, they keep their own separate brands and then they maybe review and look at should we consolidate. So we saw that with Heritage Bank and People's Choice when they merged, and now are People First, for example. But we still, I think, maybe they have both brands still in market, but definitely People First is the one that we're seeing nowadays. But it took a while for that to kind of filter through.
Yeah.
We'll take a quick break here when we come back, talking about some of the big regulatory stuff in the broker space as well. And we'll get into that just after this message. So ASIC has been busy, it seems, the last few weeks. And again, with the new financial year, one of the big things they do each time is release the levies that they're going to be charging the financial service industry. The pleasure of being regulated is that you get to pay for it. And ASIC was saying, so these are our estimates for what we're going to charge you for the year just gone, so FY25. And then they issue final levies towards the end of the year, I think in like December. So the estimates for this year double what they were last year. 109% increase on last year's figures and going up to a whopping 6.051 million. Pretty specific amount there for credit intermediaries, which of course include brokers, and a minimum levy of $1,000 for brokers, plus an additional $43 per credit rep. So interesting times. Why do we reckon it's double?
Well, essentially, I did look into this. So ASIC, they don't give any individual breakdown of the cost, but loosely it's just based on the cost of regulating the previous year. That's how they work out levies. So obviously a massive jump, doubling. And that's per subsector, but also just for financial services, it's also gone up across the board. Specifically, they didn't say this, but in terms of kind of big costs for the year, the court case around Ram's alleged misconduct, the information gathering around broker files would be two of the big ones.
Yeah, so that was the one that we talked about a couple of weeks ago. So the first testing of best interest duty, and they're going to all the aggregators and being like, give us your data on how brokers are doing that.
Yep. Exactly. And then more broadly, things like scam prevention, cybersecurity, kind of climate-related financial risks and disclosures. Lots that it could pack in, but they don't actually break down the cost.
Yeah, so we'll have to wait until December until we see why they've charged what they've charged.
Yeah.
But yeah, in July, obviously, it's estimates being like, here you go, here's what we're going to be sending your bills for. And I think, there's a lot to unpack there. Even across, actually, the whole of financial services, ASIC is actually going to be recovering almost $350 million. Huge amount of money.
Yeah.
And there's not that many people at ASIC, so I'm guessing this is lawyer costs mostly for enforcement action they have to take, because that's a lot of money to be recouping. And actually, across financial services, I think the areas that have the highest bills are still financial advice and banking. Obviously, they are kind of the ones that have been really under scrutiny at the moment. Broking hasn't really been a core priority of enforcement for ASIC this year. So we are seeing things come through like the ASIC Rams case, like the bid review. There were also a couple of other stories we wrote from ASIC this week as well, looking at old enforcement activity, actually, but court cases finalising and settling. So it's really the cost of, I think, taking people to court that is quite expensive, as well as obviously all the auditing.
I think a lot, like you think historical legal costs that you have to pay this year will be massive. I did think if it's doubling, because it's not exactly like rife with corruption. It's quite a big jump for small brokerages, but...
Yeah, one of the really interesting things that stuck out to me from the story was the reaction from the industry. I think we got some comments from the FAA, and they made a really good point where it's sort of, it'd be good to have a sort of more balanced and transparent funding model.
Yeah.
And, they sort of pointed out that the broking industry has been achieving excellent sort of outcomes for customers. The market share is massive, complaints are relatively low, and they don't really get anything back.
No.
Even though they're paying all their levies.
Whole brokers, so individual brokers obviously have to pay just for audits anyway, and then the intermediary levies that we're talking about here, this is mostly paid by aggregators because it's for credit intermediaries, not necessarily credit reps, so they're paying for their own credit reps. But aggregators as well, as we've talked about a lot on this podcast, have had a hard year. They've got payroll tax bills to look at, they've got compliance and cybersecurity thing. They've got new tech stacks they have to worry about. So they're putting out a lot of money. So actually having those double this year, not going to be great for them. They're going to be really loving that extra tightening of the cash flow.
Yeah.
But I think, like really interesting to see those comments from Naveen, I think it was, at the MAA, who's the head of policy and legal over at the association, saying, well, we put all this money out here, but we don't get anything back. Yes. And like they have to pay ASIC fees, they have to pay AFCA fees, again, for the privilege of being complained about. You pay for that. You've got to pay all of your other like fees. So for the industry as a whole, actually pays quite a lot to be regulated. So I think what she was sort of suggesting is maybe when they have penalties come back from court cases, because we're paying all of this money for the enforcement activity, but we don't see anything back. Maybe when they actually get some money come through from a penalty, we can get something reimbursed. Like maybe we can get something come back to us. That would be a good idea. And I love that. I think that's a great idea. But I think generally this has been something that's been looked at a lot because particularly, again, in the financial advice space, huge amount of regulatory activity going on there. Lots of collapses actually as well in the financial advice space. Lots of people not being able to afford to do things. And there was a Senate Economic References Committee report last year which actually looked at how ASIC is funded, because so many small businesses are like, this is just ridiculous. We can't afford to keep having these $1 million bills come through for things that aren't actually caused by us as individuals. If it's, about the sector as a whole, like why should we be paying for somebody else's fault? So there was a lot of chat around maybe looking at reassessing how ASIC's funded.
Yeah, I mean, any change I think would take a while, I imagine. I do think in terms of spreading the load, targeting SMEs with high levies when they're not really the problem is slightly unfair.
Slightly unfair.
Yeah.
We feel for them. Yeah. And I think, again, like looking at what else can be done, hopefully looking at just making it easier for people to be a small business owner. It's just a lot of paperwork, a lot of admin, a lot of regulatory and cost burden. But there we go.
Yeah.
Hopefully the associations will be in conversation with ASIC. I do know that ASIC actually as well was talking about saying, well, we actually need more people to do what we do. So that would increase the salary bill at the regulator as well, which wouldn't be great. But fingers crossed there's nothing too ominous coming up our way, but we'll have to wait and see until the end of the year.
Yeah, it's one of those things where there's no easy solution, and they are doing an important thing as well.
100%.
Yeah.
We need regulation. Yeah.
Yes.
we should have the law. Yeah.
Clear,
Yeah. But it should be, as I think the MAA was saying, they're like equitable and not too much of an impost.
Yeah.
We're going to take a quick break here. When we come back, we'll be talking about some of the big appointments we've been hearing this week as the financial year turns, and we'll get into that just after this message. So, as is always the case at the beginning of a financial year, we see lots of people changing role, moving across industry, moving into industries new. And one of the people that caught my eye this week was James Angus, who used to be over at Viking Aggregation. He's now become CEO of a non-bank lender in the form of First Federal, which I thought was pretty interesting. So I actually didn't know who First Federal was. I had to call James up and be like, great appointment, tell me about this lender because I don't know anything. And he was saying it's actually part of the same group that owns Prime Capital. So I think it's called the Multify Group. And this is basically a group founded and run by Paul Scanlon, who I think a lot of people will know. And it specialises really in kind of near prime specialist and self-declared commercial loans up to 25 million. So that kind of classic non-bank space, I suppose. It has its own warehouses as well. Apparently, it's going to be looking at ramping up to securitization this year too, according to James Angus. So James has been appointed CEO of the non-bank. And as many people will know, before he was in aggregation at Viking, he was in lending. That's been his kind of whole career so far. So he used to be leading Macquarie Bank's mortgage business and broker strategy. He also served as chief customer officer at Bluestone, which I think most people will remember before he joined Viking Residential 2 years ago, I think. So looking at what he's been brought in to do, really helping grow volume, obviously, optimizing funding and building out broker support teams. So I had a great chat with James this week about what else he's kind of looking at doing. And it was kind of the cliff notes for that conversation, I think, was him saying, we don't want to partner with absolutely everyone. We don't want like a massive business where we're just pumping out like loads of loans. We want to be really specialized in who we're targeting, who we're partnering with, and just doing it well. So he's like, we want to be able to have conversations with brokers where we know them by name, our BDMs know their business, like they know them personally, rather than kind of being like just constant churn and high volume. And he was like, and really what we want to do is, kind of specialize in those 3 core areas of like near prime and and sort of commercial loans as well. And I think what he was saying is that's why it's so important to have a great team. So he's going to be building out the BDM team. He's going to be building out, obviously, the amount of money they can loan as well by raising more money, securitization, and then looking at what else they can kind of be doing in the fully broker distributor model they have. So I think currently they're on the panel of 2 aggregators, so YBR Aggregation, formerly known as VOW, and Outsource Financial, and then they've got some smaller agreements with some of the sub-aggregators too. So looking at doing white label funding as well with brokers, which I thought was quite interesting, not with the groups themselves, but specifically with larger brokerages. And we have talked a lot about white label funding and what's been going on there, of course, with the Advantage closure. That was a big topic of conversation a few weeks back. But this, sort of saying, well, we do have white label funding options available to brokers themselves. If they want to have their own loan, we can do that. So I thought that was pretty interesting. And great to see that, he's sticking around in the broker channel too. Because, of course, whenever people have strong broker knowledge, we always want them to stay here. Talking of which, lots of other new appointments from broker groups and lenders this week. Well, what's been happening?
Yeah, loads of new appointments, as you said. So MyState Group, the newly merged group, so that's after MyState Auswide. They've named a new head of broker, Mark Woolner. So loads of experience, like 20 years experience across, that's the broker channel, financial services.
I think most people probably remember him from ING. I think he spent about 18 years at ING as head of broker.
Yeah.
And then moved to
Sultan Lime, I think.
Yeah, Sultan Lime, the debt consolidation lender,
loads of experience. And I think they've made, I'm not sure the number, but loads of senior appointments this year, as you'd expect with the
merger.
Yeah.
So I think this is great. And it's always good to have, I think, clarity on who's leading the group, because we had, obviously with MyState and Auswide, they had their own teams. So they have been restructuring that management team, and you don't need necessarily 2 heads of broker, even though I think they're running 2 independent brands again, similarly like the other mutual mergers we were talking about. This merger of the non-major banks also looking at retaining their branding. So MyState acquired Auswide Bank, and they're kind of at the moment just consolidating those teams. So Mark heading up broker for both, and he's got heaps of experience, very well respected in industry, I think, as well. Like everyone knows who he is. Congrats to Mark. Who else have we heard from this week in terms of appointment changes?
Connective, they've got a new head of broker channel. So Brad Klukas, this is a new role, head of strategic member engagement. So previously head of broker, now moving over with a kind of expanded role. Again, loads of experience, more than a decade at NAB. And he's kind of, bridging the gap between strategic execs and brokers in the middleman there.
Yeah, and I guess that's sort of a lot of like training and education kind of things. Yeah.
Exactly.
Yeah. And finally, I think there's been a few, but one that caught our eye as well was a new banker becoming a broker.
Yeah, so we found out this week that Matthew Patterson, the former head of broker at Great Southern Bank, has officially switched lanes, and he's become the new franchise owner of Aussie Erina on the Central Coast. He's sort of, as a head of broker, he's not new to the broker world, I suppose. And, our listeners might know him from senior broker-facing roles at ME Bank, AMP Bank, and Citibank.
Yeah.
Apparently he spent the past few months embedded in the Aussie Erina franchise, sort of learning the ropes. He'll take the reins from retiring broker Chris Powell, who was a signature diamond franchisee.
Yeah.
And in our story, he was sort of saying he's long admired the Aussie brand and culture, but sort of said he'd been really attracted by the people and broker community that ultimately drew him in. So
yeah, it's funny actually. I went to the Lendy conference earlier this year, and at that conference they mentioned that he was going to become an Aussie broker, and I went and had a chat to him in the breaks, and he was a bit like, "Oh, that's early. So I was a bit like, I'd love to write this story. And he was a bit like, I'm still like in the business, but I haven't yet taken over the business. So he was a bit like, I wouldn't have really announced it. So I was like, when you're ready to, we'd love to write the story. So finally we could talk about it. Yeah. But yeah, that was really good. And I love seeing bankers become brokers. And we know so many from, the Elite Broker and New Broker podcast, that's a really common pathway, but it's unusual to see a head of broker become a broker. But it makes sense to me. They spent all this time, Nat would have spent all his time talking to brokers about building their business. He'll know credit policy inside out. He'll obviously have like great client engagements. And up in Erina as well, I think he is from around that region too. Yeah, so he'll be able to like, work near his house, have like a great old time as a Aussie franchisee. Really interesting to see. And yeah, I did pick his brain about being, when I saw him at the conference, being like, why Aussie? Like, did you go and talk to anyone else? And he was just like, I think they're great. I know a lot of people here. I've had a lot of engagement with them over the years. I think when he was in lending, he did a lot with Aussie as well. So he was a bit like, just really liked them, like what they were doing. They've got this new kind of property ecosystem. He's like, I think that's exciting. So yeah, it was great to have a chat with him. And I'm glad we can finally talk about it.
Yeah, exactly.
Will, Ben, thanks so much for joining me today for What's Making Headlines. As always, all the stories are there on theadvisor.com.au. If you haven't read them, go and check them out, get caught up. Otherwise, we'll catch you for another episode next week on the Advisor Podcast Network.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.